tried to simplify 54 years of experience into 20 minutes. First thing you might say is this a preposterous notion? What do you mean extra money in this kind of environment? But supposing that you do actually have extra money, why is it we want to do something with that extra money? And the answer, I believe, is to prepare for the unknown future. And boy, do we have it now. No one certainly ever anticipated the coronavirus, or if they did, there were very few of them. There's a couple heads have popped up, but for the most part, our job is to take this capital and prepare for the unknown future. And historically, the way people did that was, the way they were most prudent was to have savings. And in 1981, almost 40 years ago, the 30-year Treasury bond yielded 15 3/8%. Today, the 30-year Treasury bond is 1.4%. So it takes 55 years for that Treasury bond to double in value at 1.4 or 1.5% versus 4.5 years when interest rates were 15 3/8. So the difference in the rate of return is what has caused your little nest egg to grow in value. There's a wonderful little book that you can get from Amazon or anybody else called The Richest Man in Babylon. And it's my children who are grown now hated me for ever bringing that up. But it's an idea of this man who started out as a laborer, let's say, became the richest man in Babylon. And he did so simply by putting aside 10% of whatever came into his coffers on a weekly basis, putting that aside and allowing that to grow and compound to such a point that over a long period of years, he became the richest man in Babylon. I'm not suggesting that's open to any of this, but right now, a person who has done the traditionally conservative thing, which is put money aside in a savings or treasury account for our retirement, is getting a really horrible return on their money, and it's a cruel hoax as to how it is we prepare ourselves for this uncertain future. So what is it we do to overcome that after we've made sure that we've got enough set aside for be able to pay our bills when times are rough? What we do is we invest in things. And what kind of things attract you? I mean, I could ask any one of you what attracts you. I mean, whether we live in a rural economy, is it farmland that attracts you, or land in general, or office buildings, or apartment buildings, or single family homes, or art, or gold, or precious metals, or jewelry, or unique cars, or musical instruments, or comic books, or operating businesses, i.e. common stocks? And so we all have those choices to make with any extra dollars that we have put aside in anticipation that it will grow and become larger. And it does that, of course, as I said, by this thing called the rate of return. So why, in our business, we focus on common stock investing. And what common stocks are simply pieces of operating businesses. And we are owners of those businesses. And whether it's Coca-Cola or MasterCard or whatever, if we own some common shares, we own pieces of those businesses. And so what we want to do as we start out on this journey of investing is think about what the historic rates of return on all these different asset classes are. And so we have taken a look at what they've been in oil, or what they've been in real estate, or unleveraged, or what they've been in collectible cars or precious metals or jewelry or comic books or whatever. And what we've found, at least in ways that satisfies us, is that common stocks on an unlevered basis have the highest historic rates of return. And those returns are in the order of 9%, or in today's world, 10 years ago, they were maybe closer to 10% or a little above it. We don't care exactly what it is, but we want to know that it's approximately in the 9% range. And we compare that with everything else. And we just talked a few moments ago about the 30-year Treasury today yields 1.4%. Compare that with 9% historical rate of return in common stocks. That's a pretty attractive place to be. And because it's an average, it does not mean that that's what you get every year. There's the old joke about the 6-foot man drowned crossing a 4-foot deep stream. And that's because in the middle, it actually went down to 6 feet or 7 feet. And so an average is just that, an average. It does not mean that's what you get every year. But it's instructive to know that at the outset, investing in common stocks over a long period of time has historically had the best rate of return of all asset classes available. At any given point in time, a 5-year measurement or even a 10-year measurement, you might find that comic books have a better rate of return or something of that nature. But so you just racehorses, who knows what it is. But over a long period of time, common stocks have had historically the highest rate of return, and that is around 9%. There was a great American humorist whose name was Will Rogers. And somebody asked Will Rogers what he did for his investments. And he said, I only buy stocks that go up, and if they don't go up, I don't buy them. And that, of course, we find humorous, but also not possible. We don't get a chance to have a backward-looking result in a forward-looking investment. But what we can do is we can make judgments about what's likely to influence the rate of return, the rate at which that business grows in value over a period of time, because that's really what we're talking about. We're talking about something that's not speculative, something that's not a wild guess. There's a way to measure what it is we do, what kinds of returns a business has, and you start that by reading in the company's annual report or reading on Google Finance or any Yahoo Finance, any of these websites and whatnot. You can read a lot of really interesting, important stuff about how fast the business is growing, what kind of returns they're generating on the capital that the owners have put into the business. And so that's what really drives us. And in our firm, we are looking for businesses that earn very high rates of return on the owner's capital. And as I say, you can use the internet to find the stuff that you want, that other people have discovered and written about, that will enlighten you as to what's going on. And so Peter Lynch, who was a very famous investor at Fidelity and ran the Fidelity Magellan Fund for a lot of years, had a rate of return that was higher than just anybody else. And he had a portfolio that typically had 12 or 1,400 securities in it. And when he would find something that he was driving down the street and saw a new store in the mall, he'd check it out to see if it was growing and if they were expanding, if they were opening other stores and so on. So the idea was invest in what you know, what you're comfortable with, what makes sense to you. Intuitively, why does that appeal to you? Does this company make games that you play with your friends? Does it have a store in the mall that you like to go to? Does it have a great web presence that you like to do? Any of those things that interest you are what you should pursue to try to find out if this is the kind of business that has an attractive future for you. And first and foremost among those things is it growing? and at what rate is it growing, and why is it growing? Is it able to grow without having to add a lot more capital to the business, and that sort of thing. So, so when I say what interests you, you know, we talked about games or Facebook or tractors or the mall or all kinds of things. You know, how do you know whether this will work for your benefit? And the answer is, it goes back to this very simple concept of rate of return. And you need to try to figure out what the rate of return of that business can be. And we do posit, in fact, and use it as a primary part of our research. We make a calculation about the rate at which the company is growing the real economic value per share. That's a pretty serious thought. We do that on a per share basis because that's how we have our ownership. And if a company is growing at 20%, but it's issuing 10% new shares every year, it means it's diluting our return. We're not getting the 20%. So we're paying a lot of attention to what's happening in growth in real economic value on a per share basis. And we do posit that our return in that investment over a period of time will approximate the rate at which it's growing real economic value per share. That's the really central idea. That is, our investment will grow at a rate that approximates the rate at which the company is growing real economic value per share. As I say, for those who are not well-schooled in financial analysis, just by going to lots of pages on the internet, Yahoo Finance, that's an old-fashioned one, you know, Morningstar, all kinds of things, you can discover what other people calculate these things to be pretty easily and use that to your advantage. So, in speaking of rate of return, one of the ways we describe what we're looking for is we describe them as compounding machines. And compound interest has had a lot of attributions. One of them is Albert Einstein, who says compound return is the most interesting thing in mathematics. And I'll give you a great example. Since I know Andrew Haley, who's watching, is a businessman here in town, and so I'm going to give him a challenge. And Andrew, in my right hand, I have $1 million. And in my left hand, I have a penny doubled every day for a month. So I'm going to ask you which one you want.
I guess intuitively I'd want the $1 million.
So intuitively you want the $1 million. Well, you'd lose. So does anybody know what a penny doubled every day for 30 days is?
Obviously I don't.
Well, let's just start 1, 2, 4, 8, 16, 32, 64, 128. How many days do we go through? About 7 or something like that. How can you? Well, let's start at the other end. Let me just tell you up front what the answer to that is. It's 10,737,418. What? How can that possibly be? That's the magic of compounding. And the simple exercise is it's 100% rate of return for 30 periods. So let's do it backwards. And so let's make it, say, instead of 10.7 million, just make it 10 million even. It's easier to do the math in our heads. 10 million, 5 million, 2.5 million, 1.25 million. Oh, by the way, on the 5th day, we're down to $650,000, $325,000, 100 and whatever that is, 62,000, you know. By the way, on the 8th day, you're down to 100,000, 162,000. So you see what happens. And the fascinating thing about compound return is that if I have $100 and it's turned into $2,000, 20 times my money, the very next time it's doubled, I'm now at 40 times my money. What? And the very next time it doubles again, I'm at 80 times my money. So compound return is a really important notion in investing, and that's why rate of return is so important. Usually I get at least a giggle out of that, you know. 1 penny turns into $10,737,418 and a few pennies. So anyhow, I would just say to you, and the way we think about this is that the bottom line of all investing is rate of return. And in our office in Middleburg, we have a number of sayings on the crown moldings going around the room. And as you walk in the room, the one that you see says, the bottom line of all investing is rate of return. So I think I've just demonstrated to you why that's important. Albert Einstein is famous for a bunch of quotes that relate to all this subject. And I think another one that we have on our crown molding is, you should make everything as simple as possible, but no simpler. And so in our business, we work in a town that has one traffic light, just one. And Suzanne and Andrew, you all, and the school is over there in the county that has no traffic lights. So, you don't get much simpler than that. And the idea is simplify your life, simplify the way you approach this stuff. Don't get involved in complicated things. There are people out there who are writing computer algorithms that take into account historical data that is almost immeasurable in terms of the scope of stuff. And they're using that in the market to trade on an hourly, on minute by minute, day by day basis. And there's just absolutely no way in the world that you can compete against them and do so successfully for a long period of time. So as I tell people, don't watch all that stuff on the program in the morning, like Squawk Box and whatnot, because they have a different business model. Their business model is collect eyeballs, consumers. And the way they do that is they make it exciting every day by, what can I do today to take advantage of this piece of current events? Or yesterday's news was that there's a possible vaccine for the coronavirus. And so the market was up 3% or something of that nature. You cannot possibly win betting against all those computers and that sort of stuff. And we just simply say it's bad for your economic health. What we suggest is that you take a long-term view, that if you're putting aside, if you're a student at this point in your life, you're putting aside for money that will be there in 30 or 40 or 50 or 60 or 70 years for you. And you want it to compound as high as you can, and do so by owning terrific businesses that are compounding the owner's capital, not by owning speculative thing. And you will understand as you go along in life that the frictional cost, paying taxes, paying commissions on transactions and so on, all cut into your rate of return. So if you can find things that you can buy and own and hold for 20 years or 30 years or 40 years, you're way better off. You have Uncle Sam becomes your partner in those investments. So as I was talking about Albert Einstein, you should make everything as simple as possible, but no simpler. He said the difference between stupidity and genius is that genius has its limits, which is a great quote. I have a cartoon in my office on the wall that is a picture of two woodworkmen out in the sequoia forest in the far northwest. And some of those trees grow to be, they're 10 feet in diameter, they're enormous. And these two axemen have chopped a big wedge out of this big sequoia tree, and one of them is lying inside that wedge on theory that the tree isn't going to fall over while he's there. And the caption under is, the difference between stupidity and genius is that the genius has its limits. I think that's pretty terrific. Another quote is that we cannot solve our problems with the same thinking that we used to create them. That's a really interesting idea, but it has to do with how we go about in our investing. The only source of knowledge is experience, and that's a great lesson for me. I've never been able to learn by anybody else's experience. I've had to do it myself. And here's an important one. Imagination is more important than knowledge. Imagination is more important. The true test of intelligence is not knowledge, but imagination. Then we have a saying around here, which we didn't invent, but it's an important one. It says good judgment comes from experience, and experience comes from bad judgment. So I would just say to you at the end, be curious, be imaginative, follow what interests you, and by all means, do not try to profit from the TV advice. It's bad for your economic health. And remember, it does not matter how much you start with. What matters is your rate of return.